All right, good morning, good evening, and good afternoon, wherever you are. So, this will be a video on weeks on and weeks off scenario. I've been wanting to make this video for a while now, but I've been kind of under the weather for the past few days. But that's by the way. So, and this video will be a short one and a quick one, and it will be precise and direct. So, weeks off and weeks off scenario, understanding this concept. So, what does it mean when you say the market is in a weeks off scenario or in a weeks on scenario? When the market is in a weeks on scenario, this is indicating that investors, traders, smart money, every market participant is currently interested in weeks. Their weeks are currently on the table and they are placing their positions in the marketplace actively. This is typically when this is a risk on scenario, meaning investors investing in risked assets like the foreign currencies, the indices market, commodities, and whatever. So when the market is in a risk on scenario, during this time, the dollar typically goes lower. So when you have a risk on scenario, you expect a lower dollar, or when you are anticipating a lower dollar, it is significant of a risk on scenario. And a risk on scenario in the retail perspective and the general public, when it is time for them to risk, it is typically where the market is bullish. So that means when it is risk on and the dollar is bearish, the foreign currencies, the indices, and other inverted as any asset that is being inverted against the dollar, it will be a bullish scenarios in those markets. And when it is a risk off asset, when we say a risk off scenario, during this risk off scenario, the traders, the investors, they are taking their risks off the table because the market is not presenting favorable conditions for them. So that is a risk off scenario. These traders, these investors taking off their risks from the marketplace to avoid any or much damage from the marketplace. So, and when we are in a risk off scenario, this will be a flight to quality. Like the smart money, the investors, they will be flying to qualities, and typically the quality currency is the world reserve currency, and that is the most stable currency for investors in the world. So it is the most preferable currency and the most preferable way to store riches. Let's put it that way, because it's not wealth. All right, as I was saying, so when we are in a risk off scenario, this is investors, traders moving to quality assets, which is in this scenario the world reserve currency, which is the dollar. So when they are flooding the dollar, this will make the dollar go higher. And when it is in a risk off scenario, the dollar goes higher. The dollar becomes a bullish market, and other foreign currencies, indices, and the commodities goes lower. So this is a simple process and a simple concept in understanding the marketplace. When you are picturing the idea of the market, of the algorithm is not just based on one particular asset, one particular market or asset class. I'm currently drawing a gear now, and you can participate in this in your mind's eye. Imagine a gear. Every gear is not on its own. Each gear, no matter the size, we don't care about, the engineer doesn't really care about the size of the gear. except when they are dealing in how they want the rotation or the precision on how it will be. That is only when they care about the size of gears. So we are not focusing on the size of the market, how the liquidity is, or how the general perspective of that market is. We are looking every individual market as a gear. So if the dollar, let's use the dollar and the indices market, because that is what we are currently focusing on. If the dollar and the indices, they are two gears which is propelling each other. So when one is moving clockwise, the other is moving anti-clockwise. So that gives you a framework to easily understand order flow. So when you come into the marketplace and you see the dollar bullish, you expect lower prices for the indices. So anytime you come into the market and you see the dollar being bullish or being one-sided, and the indices market is also being bullish or being one-sided, that is an indication of a decoupled market. That means this gear we're trying to illustrate earlier, it's when these gears become decoupled, they are not working in tandem again, they are both working independently. This is typically significant of a decoupled market. And when the market is decoupled, this will present low probability signatures in trading. So when you can anticipate this when the market can be decoupled using seasonal tendencies and also higher time frame, understanding higher time frame order flow. Other times when you can frame the market to go both sides of the direction, like you can frame for higher prices and lower prices in both the dollar and the indices, or the dollar and the foreign currencies. This means the market has been decoupled because it is not working in this risk on or risk off sense, in this risk on and risk off scenario. And when you can frame the market in a 50-50 perspective, this is indicative of low probability. This is when you have to preserve your capital, because for the dollar now, we from the market efficiency paradigm, and we indicated that the market goes to pair up liquidity or fill an old imbalance. It does one of these two things. So after making these highs here, we dropped lower and created this imbalance here. Now, having this imbalance here, we are expecting the market to retrace to the imbalance, because we noted that price goes for a pool of liquidity or to balance an imbalance. Now, because we can frame the marketplace going to rebalance this imbalance, and we can also frame the marketplace trying to come below these lows, this equal lows here. Disregard the wick. The wicks are only doing the damage. The bodies is telling you the story. So much of the volume, much liquidity is being resting below this wicks, below the bodies here. So this is like a relative equal lows. So because you can frame the dollar going lower and also going higher, this is indicative of a low probability trading, and you want to preserve your capital. You want to preserve your capital both in the mental sense and also your physical capital, because your first objective, your primary objective as a trader, as a money manager, you are more of a money manager than a trader. The concept of trading is not just about pushing buttons. It's about managing your capital, preserving your risks, knowing when to participate in the market and knowing when to spectate in the market. So when you have a scenario like this, that you cannot frame it one-sided if it's a risk on scenario or a risk off scenario, it is best for you to choose the risk off scenario as your bet. That means not participating at all, not putting risks in the market in any sense of whether expecting a risk of being you expecting a lower dollar or something like that. So that is it. Understanding the mechanism of the marketplace, understanding how the dollar is inversely correlated to assets like the indexes and the foreign currencies, that will give you a framework to work with. So when you see the higher time frame narrative being presenting itself in the dollar, for example, you can easily go into the foreign currencies and expect the opposite to occur in that foreign currencies. All right, so as indicated earlier, this is using the compare tool by your top left of your trading view. You see it too, where you can compare asset classes. So below here we have the US 500, which is the CFD for the indices for the S&P. If you look from the daily time frame, using the daily time frame now as a barometer for this, if you look at this trading, it is predominantly going one-sided. It's predominantly going in a one-sided direction, going higher. As you can see from the 5th and the 6th of June, the dollar and the indices has been going higher. This will indicate a the market trying to go into a consolidation phase or a low probability phase, and this will create this 50-50 scenario of not being one-sidedness. Don't let all of this price action fool you. You can only, most times in price actions like this, you can only participate in the order flow that has in the program that is being executed, because it has not given you that it has not given you an indication of price trying to go the opposite direction. It gives you that indication, which is typically a change in the state of the delivery from a buy program to a sell program. So until it gives you that indication, you cannot pick it up in, let's say, for the indices, and you cannot pick a bottom for the dollar. So does that make sense? So that is why it's been like this. So if you are trading the markets like this, it is best to take your piece and go. All right. And one more thing, when the dollar is poised to go into this low probability condition, this 50-50 condition, it will start making signatures of a consolidation. So it will go into like a consolidation phase. So this is for currencies traders. I think I mentioned this in the last video. So this is for currencies traders. When the dollar is ranging, the dollar is consolidating, you would want to stay away from the inversely correlated assets with the dollar. So you want to trade the courses like the AUD, JPY, Euro, GBP, all these courses, all these that is not against the dollar. Any pair that does not have the dollar being its major pair, which is trading against, that pair we have smoother price action. So when the dollar is ranging, the courses we have a one-sidedness in their price action. Exactly. You should go into price action to see this for yourself, to understand how and where to apply and how to apply this frame of thought, this risk on and risk off frame of thought, because it will help you in understanding when to preserve your risks and stuff like that. So I hope you got something from this video, and I'll talk to you in the next video, and have a nice day and goodbye.